Hi everyone, this is Shivam from MTM. Welcome to today's video. I'm going to take you through the charts for the Indian market in this video, and we'll also take a look at all the sectors and try to judge which sectors to focus on in the coming days and weeks. I'm recording this video after the weekly close on Friday, 14th of August, which should go live sometime during the next week. So the very first chart on my screen is the Nifty 50 index itself. So we've been trying to be bullish on the index, trying to mark multiple impulses from the low that we made in April back here. The exact low was 22,182. Post that, trying to mark multiple impulses and a key resistance zone at 24,500 to 600, which had been crossed for a day, but then since then it has been lackluster. Many of these candles, if you look, are closing in the upper part of the day. So most of this is going to be attributed to the latest cash changes that the exchanges have implemented. Basically, it's the closing auctions session, which is a new way of calculating the closing price. Earlier, it used to be just volume weighted average price of last 30 minutes, and now they are conducting a separate 15-minute auction session, which is still causing some price differences. So right at the close, the closing price is jumping up by a few points, which is why these recent candles are trying to look weird. Regardless of that, these do not look very strong on the downside. So if the price holds on to these lows and eventually again clears above 24,500 and 24,600 resistance, would expect the underlying trend to continue on the Nifty 50. Now, just before we move forward, if we also look at the Sensex, which is the headline index of BSE, the other exchange. Now here, the major difference is that this high, that is the April high, was not crossed decisively, as we can see in the Nifty. So all those candles making the difference. So here you can see the candles are very different than the Nifty itself. So these are some recent changes that are causing it. But here too, I think I will be watching this moving average, which is the 40-day exponential moving average, for a positive reversal from here on. But if these supports are to break, then there is a risk of a deeper correction in the near term. So before moving on to sectors, let's also take a look at a couple of broader indices from the mid and small cap segment. The ones we try to judge are the mid cap 150, followed by the small cap 250, and then there is some of both of these indices, which is known as mid small 400 index. So firstly, the mid cap 150. Now, post the May top, it still has managed to make higher tops and higher bottoms, but these converging trend lines are somewhat making it look like a rising wedge. So there is a risk that larger cap index is not moving higher, and there is a wedge like structure in the mid and small cap. So there is a risk of going wrong on the entire market view there. But till we do not see any follow up below a key moving average or any breakdown, till then it's again too early to be bearish on the market. So these structures can also mislead. So if I just show you small cap indices, this is the small cap 100 index. Now here you won't be able to see that kind of wedge very clearly. But then going back to the small cap 250, here again, the similar kind of wedge that I saw pointed out on mid cap index is still there. So let me try to draw the lines here as well. Yeah, so it fits well within those converging trend lines. But again, if the large cap indices don't break their recent lows and the 40-day exponential average, it would still look like the higher top, higher bottom formation is holding. So till then, again, it's too early to be bearish just based on these wedge-like structures. But yes, we need to be aware that this is what the broad market is doing till we figure out on the large cap whether there is a clear breakout above 24,600 on the Nifty or not. Jumping onto the sectors, so banking, the highest weightage in the Nifty 50. Again, I've been trying to mark all this rally as a corrective one and still expecting one more low here in a second wave too, but it's not even falling. So if I draw a small flag pattern here, neither did it go much up, neither nor it has gone down. So it's still moving inside it. Key factor being the 40-day average here, which is the blue line, and it's been tested for 2-3 sessions now. So any break here, I would expect this view to still play out and the index to finally form another low like this. And if the 40-day does not break and it moves out of this channel, then the this downside view would actually get invalidated. So what's causing this confusion here is the divergence between private and the public sector banks. So if I show you both of the charts, this is the private bank index. Now here you can see clearly that it's following a corrective structure. I'll change the color so you can see. So here I can clearly see corrective rallies being followed and the correction not being complete so far, and it's also clearly trading below the moving average. But what's causing the divergence on the Bank Nifty index is the PSU banks, that is the public sector bank index, which is actually now trying to make higher highs in last few days. So this was the triangle I have been tracking from quite some time, which also looked like a bearish triangle at some point, but now we should actually be looking at it as a bullish triangle now that it has broken out. So conservatively, we can look at it like this leg as A and then this triangle as B, and now it's probably going up in wave C. So that's what is causing the difference of opinion on the banking index, the divergence between the public sector and the private banks itself. Let's move on to other sectors. Now, autos have been one of the stronger pockets in the market because of this large base or cup and horn, which you can also call as cup and handle pattern, and it is trading above this resistance here. So on the daily chart also we are seeing higher highs and higher lows. So no concerns here till any major change of structure occurs. Commodities, not anything interesting so far, not not the outperformer index. Before moving ahead, I am actually taking a look at the sector rotation chart here so that we can filter out on the sectors that we are focusing on. So I try to focus on a combination of weekly and daily charts. So those of you are not aware about relative rotation graphs, so these basically plot a relative strength ratio versus the index on the horizontal axis and momentum of that very ratio on the y-axis, so that we can have a tail kind of structure which shows us data day by day or week by week, whichever time frame you've selected, and you can focus on where all the action is. So my idea here is to focus on the right part of the graph, which means whichever index or stock is trading in these leading or the weakening quadrant that has higher relative strength than the underlying benchmark, and anything that's trading on the left side of this 100 line having negative relative strength. So between the strong sectors, whichever is gaining momentum or losing momentum is the way we would try to focus this on. So that's just my approach. People can use it in different ways as well. So if I just switch around between the weekly and the daily, what I see is the sectors that we can keep a close eye on is Realty, which is clearly leading on the weekly, consumer durables heading higher, autos heading higher, and apart from that, the other ones to take a quick look at them is pharma and healthcare. Now note these are weakening on the weekly, but again these are very far from the 100 line on the horizontal axis. So these do have some relative strength. So that's good enough index list of indices to first check out on the charts, and then we can move on further. So as we check the relative rotation graph, so based on that, let's jump directly to the reality index. So again, this one trading above the 40-day exponential average touched it here, but we haven't seen a clear reversal yet. So it did trigger a bullish crossover here on few of the momentum indicators. If we try to zoom in, yes, so there was a bullish cross. For confirmation, we can have a trend line here. So if it get crossed, possibly next leg can start in the near term. The other indices that popped up on the rotation graph were autos, which we already checked out, and the other one was consumption. So this is Nifty India consumption index. While it is making higher highs and higher lows on the daily chart, on the bigger picture, so I'm going up to the weekly. So this range has been there since September of 2024. So if this is a bigger triangle, then there would be one more leg pending on the downside, which can take, eat up a lot of time and again go into underperformance. So I think the final confirmation on this sector should be to cross above this trend line, or even better, to cross above this last year highs to rule out any serious correction in a one more leg down in the triangle itself. The other two were healthcare and pharma. So the pharma first. Clearly strong. This is a resistance from September 2024, which got broken out in May. So probably more than 1.5 year of price action below this line, and now clearly heading higher with no concern so far. So till we actually break any trend line here, a trend line or a 40-day average, this trend can still continue higher. Similarly on the healthcare index, similar to pharma itself, this was a similar breakout. I have not drawn the resistance here. Yeah. So this again 1.5 year of breakout and still heading higher. So the bias here would be to be bullish on the dips till any change of trend signal is there. Coming to IT, the software names. Now this is a place where it has been very tricky to analyze lately. There was a very big HNS kind of top that we saw from almost from 2023 till early this year, and there was a breakdown. Index touched the lows made back in 2022 and again picked up, and now again uh, revolving around this resistance from where it broke down earlier. So do we have an outright bullish view here or not? So actually pretty much confused on this one. So for a safer side, we can draw one more resistance here. Correct. So this resistance can be used as another margin of safety here to confirm any breakout, because since this sector was a underperformer for such a long time, uh, is it done basing around or can still waste some time? So if you visually look at this, if it let's say it's forming a inverse head and shoulders base pattern, so again then the right shoulder is still missing like here. So with that said, there is no rule of charts forming this pattern before bottoming out, but that does help the case. Now here, the way it is spending so much time at the resistance, any big candle here like this would actually mean that it has digested this range already and ready to move further high up. So all eyes on IT in the near term to see whether it can also continue outperforming the market. So we had a quick look at all the charts that can influence the trend. So let's take a look at few other indices which I have not looked at from the rotation graph. Finance is similar to banking, FMCG. Yeah. So this one I've been mentioning in one of my previous posts and videos that there's a triangular pattern that I was waiting for it to touch the lower line. Now that it has, if this initial leg up, this one, if this was an impulse, that is 1 or A, and this triangle is likely a complex WXYXZ in 2 or a ABCD triangle in B, then if this lower end is to hold, then FMCG is a space where one more leg up can unfold. So FMCG can be looked at for a breakout above this falling trend line of this triangle. If this breakout is to happen, then some outperformance can be expected from the consumer goods as well. Public sector enterprises, the PSC index, I will call this chart very choppy in a very up down market, which we also call kangaroo market, neither bull market nor a bear market. But key observations being that it's been trading below the 40-week EMA from quite a few weeks now, and possibly trying to break down of this trend line as well. So this is not somewhere I would be expecting any outperformance anytime soon. The CPSC is a narrowed down version of the PSC index itself. So this again makes the picture very clear of what we just talked about on the PSC. Clearly trading below the 40-week and below this trend line. So not a area to focus on for outperformance. Consumer durables. This is actually doing better than the other sectors. And if I just draw a couple of resistance lines here, then it's probably already broken out. So consumer durables is something that's looking good for the very near term. Healthcare we already talked about. Defense. So on the defense as well, there have been few triangular consolidations here, one in May and the other one in June and July. But again, it did not seriously break below the rising moving average, that is the 40 period average on the daily time frame. So it's managing to hit a higher high every time. So I think a stock specific approach within this sector should be a good idea. So any outperformers within this sector can still be looked at uh, for bullish trades. Oil and gas index. So apparently this one also has a lot of public sector enterprises, CPSE stocks and Reliance, which have not been able to outperform in the recent term. That's why this chart is not very interesting. It's coiling tightly in the near term like this, but it's very hard to say which side it's gonna break out or break down. So again, oil and gas not a space specifically from Indian market point of view to focus on for outperformance. So let's just summarize what we talked about. The headline index falling from quite a few sessions. The candles are getting affected by the new closing price calculation system, but a breakout above 24,600 again would help it to continue the underlying trend, and a breakdown below this 40-day average, sorry, is actually going to be bearish. And if it does break out on the upside, the sectors that we would like to focus on are autos, the healthcare, pharma, and we are also watching Realty, IT for further confirmation signs if there's any breakout on these charts. And eventually, of course, if it's gonna go up, then banking should ideally join because it's more than 30-35% of the main index itself. So if the main index breaks out, then eventually banking has to join the party. And if not, till then it's gonna be hard for the Nifty itself to break out. So that was a quick look at all the sectoral charts for the Indian market. Let me know if you have any questions and I'll try to reply to those. Thank you.